Hi, I'm Christine Benz from Morningstar.com. With the global financial crisis now 10 years in the rearview mirror, what lies ahead? Joining me to share Vanguard's outlook for the economy and the financial markets is Joe Davis. He is the Global Chief Economist and Global Head of Vanguard's Investment Strategy Group. Joe, thank you so much for being here.
Thank you, Christine.
Joe, let's talk about the global financial crisis 10 years ago. We all have our memories of, the sort of the things that really shook us up. Let's talk about that period, what was going through your mind in the fall of 2008, where we saw Lehman Brothers and Bear Stearns collapse.
Well, it was, in one sense, I should apologize for laughing because it was such a serious moment.
Yes.
I remember actually, before I was intended to take stage that Monday morning for a Vanguard conference, seeing Lehman Brothers fail, and just the notion of dread that came upon me, because I didn't know exactly what would happen, but I did know that the economic fallout would be significant. I know over the next 6 months, I think what was very important, one, we saw obviously radical policy responses. The one thing I think I'm very proud of our outlook for Vanguard was saying that, listen, there is a palpable chance that the global economy completely disintegrates. But I can tell you the market is assigning a much higher probability than that will likely occur. So we're probably going to have a very somber period of economic conditions, but we should separate that from our investment portfolios because the market's really discounting a lot of negative things. And it was not fun. I mean, I remember my own views were being challenged with my own emotions, Christine.
And it took a while to recover.
But I tell you, by sticking to that and saying, listen, we actually at one point internally mapped what would economic growth be given where the stock market volatility and the negative returns are. And it said, listen, GDP growth would have to contract twice as much as the Depression at one point. I said, no, that is possible, it could happen. I think that's unlikely.
To justify
valuation. So that was an important mapping for myself and I think for some of our clients. And so if anything, the investment returns have been even stronger than I would have expected. We were more bullish than most in 2009, 2010 from the investment perspective. But if anything, it's certainly been stronger.
Yeah. Would you talk about how the recovery has played out? Has it played out, it sounds like, fairly in line with your expectations? Were there any surprises or any things that played out differently?
Well, I think there was definitely some surprises. So, I mean, we were generally of the view that the recovery was going to be slower than average, but we were if you're self-critical of our outlook, I would say we were still a little too optimistic on growth. We were still closer to 2.5%. When some years it was like at best 2. Yeah. I think we thought the Federal Reserve at one point would normalize a little bit more quickly than they did. We were very accurate on inflation was not going to take off. There was concerns that either inflation was going to take off or would go negative.
Because of all the stimulus.
Because of all of that. So generally speaking, it was fairly good. We were very good in terms of the equity risk premium and our outlook for stocks, broadly speaking. Because we were valuation based, and we said that will matter. So that was generally a good record, but it was far from perfect. And I think, and now today, I think we're trying to challenge ourselves because I think most asset management companies have a similar outlook, which always concerns all of us, right? Everyone's seeing the same thing. So that's what we're trying. I haven't found what the secret, the unexpected risk is, but that's something we're challenging ourselves.
Okay. In terms of the recovery, are there any aspects of the recovery that are concerning to you? We have low unemployment, a lot of things that are right about the economy, but one big thing is just that we've seen the income trajectories of some workers go in the opposite direction. Is that a concern to you?
It is definitely a concern. It's something we follow. Actually, we have had a mindset that many elections around the world, Christine, we don't have any unique insight on geopolitics, but we've generally evolved the view that most elections will always be closer than the polls would suggest because statistically we have found a link between the rising income inequality and some of these other trends we're seeing in the political sphere. So, and I don't see this trend reversing unless we would see a profound increase in productivity like we saw in the late 90s. If you remember the late 90s, growth was much more what some would call inclusive. Household incomes were growing up 10% across the income distribution. But I think the nature of the job change we're seeing continues to put a greater reward on certain skills and certain educational backgrounds. And that's global in nature. So I don't see that falling anytime soon. And so that is the biggest concern I have. Rather than the rate of growth, it's the distribution around the growth.